Kenya Central Bank raised its discount window rate to 13.8%. That was today, following a revision of the overnight lending rules. That was last week. Joining us now is Fred Mweni, who's Managing Director of Solve Securities, for a look at the effect it's going to have on the markets. Fred, it's always great having you. The CBK coming in saying that the discount window rate is 13.8%. What impact is that going to have?
First of all, the 13.85.7 comes from the average of yesterday, which was about 10.8. Then they put in the penalty of 300 basis points. Now, the impact this one has had today, for example, was a nightmare because one of the conditions that came through is should a bank go borrow from the window, then they cannot lend the same very day. So what it means retrospectively is if you have your cash in the morning, you will not be able to lend until you are sure that if you lend, you're not going to borrow from central bank. Because again, if you borrow from central bank the next day and the other day, you cannot be able to lend. And this one has really messed up the entire system. So we closed the market today with some section of the banks having excess liquidity, which they couldn't lend because they didn't know how much the squaring is going to be. And then on the other side, we have had these people who are deficient from the morning and they could not get to the overnight window. And therefore, by the close of business, you realize it's a whole mess.
Okay, explain to us also what's happening just by way of the mathematics here. Simplify it for me. You know, we're seeing the discount rate at 13.8%. We're also told that rates will effectively be the CBR, which is above 6.25, plus 3%. And the CBK saying all of these is meant to create a realignment in rates across the spectrum of bank lending rates. Is it going to do that?
It's not going to do that. First of all, the whole of this policy, number 8, was supposed to address the volatility on the forex. And therefore, they're trying to handle it from the side of liquidity, where they can be able to restrict liquidity to force the banks who have excess or some holdings in forex to be able to offload and then therefore create less pressure on the forexes, probably the dollar coming down to maybe 90 or something. But something they forgot to do, which is the whole thing that makes this thing not effective. One is we're in a situation where by this particular week, yesterday we had more than 27 billion maturing on repo. That was a big factor. Then secondly, we are approaching the 20th of the month where, you know, VAT payments for taxes are falling due. So having restricted the flow of liquidity when those two things are happening is a wrong thing. Because what was going to happen or what's happening right now, banks are not necessarily going to sell off their forexes reserves so as to raise liquidity for short term. That's one thing. And then secondly, they are affecting more on the interest rate side.
Right.
If the whole idea was to make interest rates stable, then tightening liquidity literally means the person who is supposed to be lending the bank is going to think twice before they lend. One is going to be either increase the minimum requirement for lending, or secondly, reduce the amount that are going to lend for the month so that they can sufficiently remain liquid for the period. And therefore, the policy has not helped anything.
I mean, I suppose also for the bank, you know, especially because they are heavily geared towards treasury bills and they've been hammered by changing yields. The idea is that this should also help them because effectively what we're going to see is a rise in the interest rates on treasury bills, and ultimately it should help banks realign their treasury management positions. Is it going to do that?
It will have done that if the government was not in the market on the borrowing side. Now, there's the tragedy. Next week, we are closing the Premier auction for the 30-year paper and the 5-year paper. All these papers are being opened, and you're looking for 10 billion. The amount is not about the 10 billion. The amount is about the direction of interest rates. Who is going to participate in a Premier auction when you know clearly interest rates are going to go up? That's one question. Then the other thing is their alignment can be effective if, for example, we strictly want to manage liquidity with the interest rates. That works very well. Or you want to manage liquidity with forex. But if you bring the third component together, we have interest rates on one side, you have forex market on the other side, and then you have liquidity on the other side, it becomes very difficult to manage that. And I think we are not effectively going to see the alignment there because the best that banks can do when they are tight on a corner is probably to do horizontal repo, use some of the securities to the other banks, which is going to be a bit hard to do because even the other banks are also short of liquidity.
Right.
Or the other side is to say, look, I have some TBs or some bonds, let me discount them at the central bank so that I can get my cash back. Now, that may work if banks decide to take some losses on some of those assets.
Ultimately, the CBK also wants to reduce the pressure on the shilling at the moment because of a variety of forces. We've just seen trade figures coming through. The import bill is rising, and that's definitely going to have a bearing on the shilling as well as on inflation in the economy. And that's compounded by the drought and the fact that the Horn of Africa, you're seeing a lot of dollar demand to get those grain imports to the people who need it the most. What are your expectations for the shilling, and what else can the CBK do to really mitigate against the pressure that the currency is under?
Thank you. Two questions. My expectation for the shilling, I think we're going to play around 93 to 95 for this band of period. Second question, what can they do more? I think they still have more room to do. They can pull out from the bags. They have the foreign reserve limit of 20%, which banks, I think, have exhausted. If really the central bank want to see a real drastic movement on the forex, and particularly on the Kenyan shilling probably gaining against the major foreign currencies, and I'm talking about the euro, the British pound, as well as the dollar, maybe they may have to touch on that one, probably say, bring a new rule, which I think can be effective, is to say, look, instead of having a limit of 20%, let's cut it by half. Let's say maybe, for example, only allow 10% of the CRR to be the exposure towards the foreign currency holdings in that basket of the currencies. I think that can be very effective, but obviously I know they can't do that overnight because that is going to kill a couple of other sectors. So what they can say, like, for example, we are giving you 3 months or 1 month to make sure that you align your basket of forex exposure from 20% to 10% or 15%, whatever percentage. Now that one is going to see a bit of the shilling strengthening against these major currencies because that means there's going to be supply and demand is going to be less.